In this video, we're gonna have a look over at the financials of Target. Now, Target is a massive retail corporation headquartered in the United States of America, and it has a lot of locations there. Now, recently, Target has gotten into the news quite frequently because of something that's been happening. Namely, they have been catering to the LGBTQ plus community to such an extent that it angered certain conservative people. We have headlines like Target loses 10 billion in 10 days as stocks fall following boycott over LGBTQ friendly kids clothing. And we also have headlines like this: conservative boycott against Target and Bud Light are working thanks to a perfect storm of social media and culture wars, experts say. So in these articles, they attribute a lot of the downfall in the stock price to the recent shenanigans going on with their LGBTQ boycotts. And even though I do agree that the share price has dropped significantly, I actually do not agree with the fact that this is because of the boycott. I think Target has different reasons to go down in price significantly, and I will go over that in this video for you. Because looking at Target's revenue, we can see a steadily increasing revenue from 71 billion all the way to 109 billion here in 2022. But we can also see that their margins, at least for the last year, has been shrinking significantly. They had an EBITDA of 7 billion in 2013 and an EBITDA of 6.5 billion in 2022. Now I do want to note that this is January 31st, 2023. So this means that this number precedes the boycott that's been going on in June of this year, 2023. So their very low earnings numbers was prior to any boycotts. Now, of course, you might believe that the boycott will only add fuel to this fire and their future earnings are going to be even lower. And while that is possible, I kind of doubt it to the extent that we already see over here. I think the effect on the boycott will be very minimal, all things considered. I think all the numbers and all the articles that you see about this boycott are a bit over-exaggerated to really drive home the message that the boycott is actually working and we should go anti-LGBTQ. Now, I'm not going to post any opinions on that. You can think of that what you will, but I don't think it has the effect that many of these articles claim. So let's have a look over at their margins here. So we take their EBITDA, we divide it by their revenue, and we can see a steady margin here of around 10%. If we do the same for the other 9 years in our spreadsheet, we can see that for 2022 they had a very low profit margin of around 6%, which is very scary for their future earnings, because in their 10-year trend it actually shows that their EBITDA has been decreasing by 1% every single year. Now, it is possible that 2022 was a bit of a blip because inflation also started to affect their inventory, and 2022 was just a very low number for them, all things considered. It is possible that this is a one-time event, but just in case it won't be, it will really drastically affect their share price. Looking over at their debt level, we can see a very steadily increasing debt level of 13 billion here in 2013, which has risen all the way to about 18 billion in 2022, which was very unleveraged here. If you just look over at the numbers here for 2021 and 2020, you can see that about 1 year of EBITDA almost covers their debt level already. But because their EBITDA has shrunk significantly in 2022, it actually starts to get a bit into the dangerous territory. Nevertheless, they also have quite some cash on hand, 670 in 2013, 2 billion here in 2022 to really cushion any blow that might be coming their way. Market cap has been increasing by about 7% every single year. Enterprise value is the entire value of the business. So it's the market cap, so the price on the open market itself, to which we then add the debt and we subtract the cash. And then we get a compounding annual growth rate of enterprise value of 5.9%. Now, the reason I take enterprise value is because it incorporates all the values that the company has. So the moment that a competitor, let's say Costco, wants to obtain Target, wants to acquire Target, of course they have to buy the shares from the open market, but they also have to incur the debt that Target has on their balance sheet. It's part of the company, and I think it's very weird to not include that part if you make a valuation. And that's why I always incorporate debt and cash into my valuation and turn it into the enterprise value. Looking at their multiple here for the past 10 years, on average, they've been around the 8 to 9 times. For the past 3 years, they've definitely been a bit higher than that. And I think this is mostly because during the COVID pandemic, many investors actually went into the more safe and staple stocks like Costco, like Target, like Walmart, all the things that, because people always need their groceries, right? So it's a very safe place to put your money. and I think that's why we see a bit of a multiple increase here in the past 3 years. But overall, I think it's fair to say that multiple has been around the 9 to 8 times. Net debt to EBITDA, like I mentioned, overall they've never really been in any dangerous territory apart from their 2022 numbers, which is really mostly influenced by the fact that their EBITDA is 6.5 billion compared to 11.5 billion 1 year prior. It decreased by 40%, which of course will increase their leverage because now you need 3 years to cover your debt level. Looking over at cash flow, we can see that their cash flow from operations was 6.5 billion in 2013 and it's only 4 billion in 2022. Every single year their cash flow number dropped by 5%. That is quite a scary and drastic change, but of course it's again influenced by the fact that 2022 is a very odd year. But just in case this trend continues, it bodes very bad for Target's future price target. Capital expenditure, even though cash flow has been decreasing, capital expenditures, so all the money that they have to put into the business to try and future-proof it, any additional payment systems, any additional storefronts, anything that you really need to keep on future-proofing and also developing your business is included into capital expenditure. And we can see that this has increased from 1.8 billion to 5.5 billion here in 2022. So even though their earnings were very low, their capital expenditure was very high, which means that 2022 was the first year ever that they saw a negative free cash flow. Free cash flow, of course, is your pro rata ownership of the company. This is all the money that's available to you as an equity owner, as an investor, in the form of either dividends, share buybacks, additional acquisitions for the company itself, or them buying back debt. And we can see here for Target that they've been steadily decreasing their share count. So they've been rewarding investors by buying back shares, 3% of their total float every single year. And they've also been issuing a dividend in line with the amount spent for their share buybacks. The moment that you take their free cash flow and you divide it by the amount of shares outstanding, you get the free cash flow per share, which has been standing at $7 here in 2013. It has risen all the way to $15 in 2020, the start of the COVID pandemic. But here in 2022, they posted a negative free cash flow. Again, it's way out of the ordinary compared to all the previous numbers, and I do expect them to recover from this number, but it's still a bit of the odd one out, and it's also the one that we currently base most of our projections on. Price per share, so this is the price as seen on the open market itself, was $56 in 2013, a high of $231, where we also saw a massive EV/EBITDA ratio increase of around 11 times, as opposed to the usual 8 times. So this is also why we see a bit of an increase in share price here, because the multiple has expanded in 2021. In 2022, we see their share prices come down to $150, and if you look at the open market right now, you see that this share price has come down even more. But nevertheless, we see an increase in share price of around 10% every single year, which is a very nice and steady return. Free cash flow yield on average has been around 7.5%, which I think is definitely influenced again by this final number of minus 2.2, which it kind of brings the entire column down. But I think overall, the moment that we start to normalize this number, we see a free cash flow yield more in line with 8 to 9%. So this then brings us into the business of trying to forecast Target in the next 10 years, which is quite a tricky thing to do, right? Because this final year of 2022, we're not sure how to handle that number. But I think personally that Target will recover their earnings, and they will also recover from the boycott that's been happening here in June 2023. I expect them to kind of reach their 2020 number of earnings, and I'm going to grow that by 3%. So I'm not going to say they have the ultimate high point here of 11.5 billion. I'm also not going to say they have a earnings of their lowest point ever this year of 6.5 billion. I'm going to stay in the middle. I'm going to say that they can achieve their earnings in 2020, and we can project it from there, which gives me 9.3 billion of earnings in 2023. I'm going to grow it by 3% annually for the first 5 years and then 2% for the last 5 years. And the reason that I do that is the moment that you actually look and try to normalize this number, you do see an EBITDA growth of around 2 to 3%. So I'm going to give them the benefit of the doubt here in the first year of 2023, where I give them 3%, and I'm going to bring that down to 2% for the last 5 years. I'm also going to attach a multiple of 8 times, which I think is their historic average For the last 10 years, it has been 8.8, but like I mentioned, this is mostly influenced by the last 3 to 4 years, where the multiple has definitely increased compared to their overall trend because of the COVID pandemic, which really affected many companies' multiples. So I'm going to bring this down to 8 times to be a bit more conservative here with my estimate. This gives me an enterprise value 10 years from now of $92 billion, from which we then subtract the debt, we add the cash, gives me a market cap of $76 billion, divided by the amount of shares outstanding. And I'm assuming here that the amount of shares outstanding remain the same. More likely than not, they will actually continue to buy back shares just like they have been doing here for the past 10 years. But I can't go ahead and spend their free cash flow for them. They have to do that themselves. So I can't really make that assumption, especially because I also use their free cash flow model as my next model. And I'm including their free cash flow in my returns. So I can't really go ahead and spend it twice. So I'm going to remain their shares at 465 million. This gives me a stock price out 10 years, so in 2032, of $165.29. And I'm going to do a similar thing here for their free cash flow model. I'm going to take the 2021 number of free cash flow per share because I think this is once again the bridge between their very high point of $15.68 and their low point of minus $3. I think $10 free cash flow per share is in line with the overall growth that we see here for Target in the last 10 years. I'm going to grow that by 3% every single year and then 2% for the last 5 years. I'm also going to attach a free cash flow yield of 8%, even though right now historically they show 7.5. It's again influenced by this final number, so I'm going to put it a little bit higher at 8%, which gives me a stock price 10 years from now of $165.77. And I think these two models really get to the crux of why we see Target drop in share price so drastically. Because even if they recover to an EBITDA number in line with their 2020 earnings, I still expect a share price of $165. So this means that the share price that they saw in 2021 of $231 is incredibly overvalued considering the growth and considering the earnings that they have, as well as the multiple that's attached to it. So if anything, I think Target was way overvalued in 2021, 2020, and I think it's only coming back down to reality. And this is not as much to the boycott as many people would like you to believe. Looking at the open market right now, I can buy as many shares of Target as I want for $128.72. Taking both my projections of the enterprise value model as well as the free cash flow model, I expect an overall share price 10 years from now of $165.53. This gives me a compounding annual growth rate in the stock price alone of 2.5% annually. But the moment that we actually include the free cash flow that we have projected here in our free cash flow model, we get an IRR of 12.8%. I always say on average the market returns about 10% annually for IRR, so I think when it comes to that, with the current prices, I expect Target to perform in line with market expectation. So let's have a look. So let's see what happens if the price goes up or comes down a little bit. So the moment that the price drops to about $100 per share, I expect an IRR of 17.2%, which is very attractive, I think, for any stock, especially one as stable and conservative as Target, because everyone always needs their groceries. The moment that the price goes up to about $150, $170, I expect an IRR between 9 and 8%, which is definitely underperforming the market. So I think if anything, Target shows that even though they have come down in price significantly, so they came down from about 250 all the way to 128 where it's sitting right now, I still don't think that Target will outperform the market, even though their share price has halved in the last few years. I also don't think the boycott will have as big an effect as many people claim it has, and I definitely think Target will be around for many years to come. So that was it for Target. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!